Good morning. It's Jeffrey Christian of CPM Group. It's the 11:50 in the morning on Friday, the 10th of January, here in New York. I'll talk about precious metals prices, which are up today, and some economic factors and where we think it's going. But I really want to talk primarily about how producers and investors can lock in minimum prices for gold and silver. And protect themselves from sharp declines in prices while continuing to have exposure to the upside. Hedged investing and hedged production for producers. I'll run through some examples of what we priced over the last couple days in the market. Today's topics, as I said, I want to talk about prices. Gold and silver prices are up today. I'll run through some comments on employment data, which came out this morning, interest rates, which have been rising, the dollar, which has been rising, other currencies, which have been falling, especially Asian, our price expectations, and then I'll go through these examples of what can be done to protect yourself as a producer or an investor against declining prices in a reasonable, rational way while preserving upside exposure. As I said, prices have risen. These are the prices through yesterday. We've seen gold basically trading in a channel really since the end of October. The price had risen very sharply in the second half of October. It came off, and it's basically been in a channel between, say, 2,600 and 2,700 since that time. Today, we've broken above that. The price of gold for the February COMEX contract got as high as $2,735. It's around $2,718. We have been talking to our clients and to others, including our video last Friday on the 3rd of January. We have been saying that we thought that this consolidation period could last for a few more weeks, but that ultimately prices would break out on the upside. And that when that breakout occurred, it would be a reflection of financial markets' increased concerns about economic and political factors. We may be seeing the breakout of that out of that consolidation period today, although we wouldn't be too surprised if the prices fall back yet a bit again next week. Our expectation is that the prices will rise and will rise sharply over the course of 2025. Not quite sure if this is the beginning of that breakout of that consolidation phase or a temporary rise. The fact that the price rose as sharply as it did, but then came back off, and has done that now 2 cycles over the last 3 hours, suggests that perhaps it's not quite time to break out. We've seen similar situation in the silver market. The silver market actually was showing greater weakness over the period November, December, into January. The price has been picking up. It was testing $3,100 yesterday. It got above $3,100. It broke up, rose very sharply to $31.84 earlier this morning after the employment data came out. It's currently trading around $31.34. As with gold, we're not quite sure that this is the breakout that we have been expecting. I mentioned the employment data, and it came in very good. I think that the financial markets consensus expectations, which we usually don't pay a lot of attention to, was probably around 150,000 jobs, and it was about 260 some odd thousand jobs created. Unemployment was largely unchanged. I think it declined to 4.1 from 4.2%. So relatively healthy employment market. Interest rates have been rising over the last week or so, basically because financial markets expect higher larger federal deficits going forward. The incoming Trump administration has made a lot of comments and promises, and it's already backtracking from some of them. One of the things that we've seen is that the explanation in the bond markets for the higher rates. 5-year rates are getting close to about 4.7%, and the expectation is that'll get back up to around 5% over the next few weeks. The explanation that bond market traders have is that there is a growing realization that the deficits will not decline and government spending will not be cut back under Trump. And looking at his previous administration and looking at previous Republican administrations, the expectation is that spending probably will actually rise and the deficits will increase. The Congressional Budget Office had done an analysis late last year suggesting that you could see about $7 trillion added to the federal debt balance under a second Trump administration. And that actually may be low. Yesterday, Elon Musk said that while he had been talking about slashing $2 trillion from the federal budget, that would be what he now is calling an ideal situation. He doesn't think that he can slash $1 trillion from the federal budget because I guess he's started to realize that he doesn't know what he's talking about and that the federal budget is much more complex and the federal government is much more complex than his mind can comprehend. So we've seen interest rates start to rise, and we're seeing the dollar start to rise. And the dollar is rising for a variety of reasons, one of which is that the U.S. economy is much stronger than people thought, and the U.S. economy is much stronger relative to other countries. We've seen particularly weakness in Asian currency markets, and there has been something of a correlation, at least a loose correlation, between declining Asian currency exchange rates and increased buying of gold, especially in Asian markets. There are people who talk about a mystery buyer coming in during these periods of time and buying gold. And we don't agree with that. We don't believe that. We believe there's a large number of buyers, institutional investors, high net worth individuals, governments, and others that are buying the dollar, going into gold in periods of time when they're also buying the dollar and their currencies are coming down. We don't think there is a mystery buyer, but we do see this recent renewed interest in buying gold and the dollar on the part of Asian market participants as perhaps indication that the period of consolidation is drawing to an end and that we are going to see a movement above $2,700 on a sustained basis in gold prices. So the dollar is relatively good there. Before I jump into the hedging issues or insurance purchases, I'll start with this chart. Our expectations have been and continue to be that we'll see higher gold and silver prices in 2025 and possibly into 2026, predicated on investor buying of gold and silver continuing because of investor concerns about economic, financial market stability, and political conditions. That's probably likely to be there. I'll talk a little bit more maybe next week in one of our videos about silver and silver investment demand on a gross and net basis. Looking at how producers and investors can protect themselves from declines in gold and silver prices, the first thing is to understand and really understand that gold prices above $2,500 are unique. We were never at $2,500 until August of 2024, 4 months ago, right? And prices above $2,900 are yet to be experienced. We think that we will experience them possibly in 2025. But that's our expectations based on our research. There are other people who have much higher estimates of where the prices will go, but those estimates are based on beliefs, and they're based on beliefs that have been held for years and decades and have yet to come true. So that's a different story. But understand first, $2,500 is a very high and good price for gold, especially if you're a producer producing at an all-in cost of, say, $1,600 an ounce. And if you're an investor that bought at $1,600 or $2,000, or in my case, much lower, my average acquisition cost is somewhere below $1,000. Locking in protection against prices coming back below $2,500 makes a lot of sense. And that $2,500, that's a new experience only in the last 4 months. So bear that in mind when you look at these. These are strategies for prudent, intelligent producers and investors. There always have been and always will be people who will forego realistic and reasonable profits and price expectations while waiting for the dollar to collapse and gold to go to $10,000 and silver to go to $3,000. I was talking about silver in our Tuesday video, and I mentioned that we thought that the average price might rise another 20% this year. And one of the comments from obviously a true believer and not a student of history was 20% increase in 1 year. Oh, that's just like, that's piddly. I'm not going to bother with something that small, because he's looking for $3,000 silver. And, probably he will be looking when they lower him in the grave. These are realistic, reasonable price insurance programs based on reasonable, realistic price moves. The first one that I have here, and it works for a producer hedging its production, and it works for an investor protecting its buying, or actually buying on a protected basis. You can lock in a minimum price of $2,500 gold, and you can get the price of gold all the way from $2,500 up to $2,900. So if we've gone from 2,600 something 3 days ago to $2,718 right now, you could be getting $2,718. Over $2,900, you give up a maximum of $150 per ounce of the upside. Now that sounds like a lot, and it is a lot. But again, we've never been at $2,900, let alone $3,050. So between $2,900 and $3,050, you as a producer would be getting $2,900. And then if the price continued to rise above $3,050, you would get whatever the market price is, less $150. You would have total protection below $2,500, and you would give up $150 if the price rose above $3,050 on a sustained basis. Kind of an attractive hedge, kind of an attractive way to buy gold. Here's a different one, $2,500 floor once more, but you pay for it in a way that you give up $40 above $2,540. So you would be losing $40 of mark-to-market potential profit today. But even if the price went to $50,000, at $10,000, you would be giving up $40 of it. You'd only be getting $9,960. Pretty good one. Those are two gold strategies that we pulled together on January 8th, 2 days ago, Wednesday. Did silver ones yesterday. And again, with silver, got this red line. It's just above $25 so that you can see it, and it's not obscured by that black line at $25. That's a $25 level. And again, you can see $25 was relatively scarce, and more importantly, $35, which comes into play when you see my hedges. $35, we've been above $35 for about 4 months in early 2011 at the height of the international sovereign debt crisis and the movement to downgrade the U.S. Treasury's credit rating post global financial crisis and Great Recession. 4 months, January through April of 2011. So $35 is very rare. $25 and higher is pretty rare too. Something to bear in mind when you look at these strategies. I have 3 silver strategies. The first one is you lock in a minimum price of $27 an ounce. You get the market between $27 and $33, and then you give up $2 above $33, above $35. Between 33 and 35, you get 33. Above 35, you get the market less $2. So if the price does go to $3,000, the way some of the guys on the internet are talking about, you're going to get $3,998. But if the price stays below $35 or $33, you're going to get the market. And if the price falls back to below $27, you're going to get $27. $27, again, if you go back and look at this price, $27 is a pretty high price for silver, historically and realistically. Realism is important in investing. Here's another one. Lock in $25 as a minimum price and give up a quarter, but you give up a quarter all along. So today you wouldn't be getting $31.34 right now. You would be getting $31 and I guess about 9 cents. And if the price goes to $50, you'd get $49.50, $49.75. You give up a quarter. And then a third one, lock in $28 and give up $1 on the upside. Those are, again, realistic, reasonable strategies for prudent, intelligent producers and investors. And this is the kind of stuff that CPM Group does when it's advising producers and investors. We will have our gold yearbook in late March, silver yearbook late May, platinum group metals yearbook late July. We'll be doing our silver reception at the PDAC on Sunday, March 2nd, 21st year of doing that, I believe. The week before that, we'll do our Silver Facts and Fantasies online seminar. People will be invited to send in questions and topics that they want us to address, and we'll do that. And then we'll have a little bit of a book, and we're starting to put all that together now. We do plan to have a silver seminar tentatively late in October, tentatively in Boston. That's all I have for today. Have a good weekend. Stay warm if you're in the northern hemisphere. Stay calm if you're in the southern hemisphere. You can go to our website. You can pre-order our yearbooks for 2025. You can order 2024 yearbooks. You can send us emails at info@cpmgroup.com and talk to us about ways that we can help you and work. If you're impatient about the yearbooks, you could probably suggest and do a deal with us where if you pre-order the 2025 yearbooks, we'll send you a 2024 yearbook that you can read in the interim at no additional cost. So you get the 2024, you can read it now, then you can read the 2025 yearbook and see what's changed over the intervening 12 months. That's all we have. Take care of yourself. Take care of those around you. Try to do something good for the world. And we'll talk to you next week.